Hey there, it's Mitch Goldberg. You are watching Be the Boss of Your Money. This is a live stream. It's about personal finance. I gave it the name Be the Boss of Your Money. I thought it was clever. I still like it, but it's really about taking control of your money. It's very easy for your money to take control of you. Your assets, your liabilities, before you know it, you're working for assets and liabilities. You're working for someone else. You're not working for you. I don't mean that like you own your own business or not, because I own my own business, and I promise you, I don't work for myself. I work for my clients, and it's actually pretty gosh darn demanding. I love it, and I wouldn't have it any other way, because I love doing work for the end user, not through the middleman, the big firm, and then it's got to get processed to a certain way with a certain sales quota, with certain products, regardless of conflicts to the end user. That's a lot, right? So that's the deal here. It's about you being the boss of your money, taking control of your money, personal finance, taxes, insurance, credit scores, paying down debt, financial planning, retirement planning, income planning, you name it. We even talk about health here, but let's get into it. We've got a couple of things to get into. Fed meeting going on today and tomorrow. It's a 2-day meeting. They come out with a statement tomorrow. Biden's tax proposal. It's a doozy. It's a big doozy. I'll tell you why I don't think you should worry about it too much, though. Okay. It's a year since we had that down 12.5%, 13% down day, exactly a year ago. We'll talk about that, what's changed, what happened, and just something you should know about filing your taxes if you were one of the people who did collect unemployment insurance. We've got a few things for you as well. So let's get into it. We're going to roll the intro, and it's going to be a good show. Stick around. And we're back. You're watching Be the Boss of Your Money. I'm Mitch Goldberg. Thank you so much for joining me. Your time is very valuable, and it means a lot to me that you chose to spend some of it with me. We've got a couple of things to talk about. If you're watching this in the live stream, if you have any questions, please ask me in the comments. Words of wisdom, words of encouragement, they are always appreciated. If you've got a lesson you'd like to share with us about your personal finance journey, success, mistake, or how you solved the challenge, you overcame a challenge, that's the stuff that I love to get into. I'd love to answer your questions. If you're watching this in the replay, hey, thank you so much. I realize not everybody could just stop what they're doing at 4:30 p.m. and just watch my show. But maybe you could, put it on and listen to it in the background, maybe, or whatever. Just watch it in the replay. And if you have any questions, you hit me up in the comments. Also, words of wisdom, words of encouragement from you are also appreciated. So just you stay around here. We've already got somebody out there. We've got my good buddy Josh to get royalties from Kleenex, because the thumbnail picture is with me, boo-hoo, with my tissue box. Boo-hoo, Biden's tax proposal is going to end the bear market. I'm so sad. No, he's not going to end the party. Look, it could. But we've got a few things to go over. Okay, I know you meant Kleenex. I got you, buddy. Thank you very much. You could spell it any way you want, okay? It's my show, and I said you can spell Kleenex any way you want. All right, so let's get into it. Mitch Goldberg here. Thank you very much. First of all, some housekeeping. If you filed your taxes, or if you filed or not, or you're going to file soon, the deadline's coming up, okay? I'm up here in the left-hand corner. $10,200 of unemployment from 2020. The first $10,200 will be tax-free, because unemployment benefits are taxable. I think the average person got like 12 or 13, but let's say about $12,000. So almost all of it would be tax-free for the average person. I realize average doesn't really mean a lot. Some people got a lot and are still getting, and some people were on it for a short amount of time, and fortunately they were back in the saddle with a job, and that's what people really want. But if you did file your taxes already, the IRS says do not file an amended tax return yet. They haven't come up with the proper document or form for you to sign. And you also should not, if you haven't filed yet, don't delay filing your taxes. April 15th is one day short of a month now. So you still have to file. It's just that the IRS hasn't gotten around to giving us guidance or forms yet in terms of how the paperwork or the electronic filing should work. The IRS is working with the electronic software companies to get this done, and they're working on the appropriate paper form that you could download as well if you want to go that route. Okay, so just wanted to share that with you. And then we've got a couple of things to take a look at. So we could do a whole 10 hours on this or more, but we're not going to. A year ago, the world was ending. I had the opportunity to speak with a reporter at NBC News about this today. And she actually interviewed me last year, exactly a year ago, when the Dow was down 13%. So she sent me an email last night, and she thought it would be a good idea that we revisit the issue and what's changed. And some of the things you can't include everything in the article, but what a long, strange trip it's been. So I'm calling this the Jerry Garcia trailing 12 months in the stock market, right? He's the one who said, what a long, strange trip it's been. All right, I'm not going to sing anymore for you. If you want me to, I'll give it a shot. All right. Excuse me. So I'm a little verklempt. So a year ago, the Dow tanked 13%. We were sliding. I don't know about you, but a year ago, this was the first week that my school district closed. And that was pretty much for New York, the whole state. Schools closed. And imagine it was like this wherever you live in the country, schools closed. And you always, when you have kids, you kind of mark the days, months, and years of your life based on what your kids were doing on their birthday parties, their milestones, and everything like that. It wasn't until the following week, the 20th, March 20th, when Governor Cuomo, the besieged government, Governor Cuomo, gave the order, everybody go work at home. So that's when it really started to get real. And that's when you saw the lines at Costco and Target, and you couldn't find toilet paper and paper towels and other paper goods. Things started to get scarce. People were hoarding. And look, we've talked about the market. I've been live streaming since well before the pandemic, and we talk about this all the time. So this one came out today. Get myself up here. All right, I'm back in the corner up here. COVID crash a year ago. And, some of the things we talk about was the Federal Reserve. Okay, there it goes. You weren't seeing it yet. The Federal Reserve. Here's the stock market in the last year. Because even though the market was down about 13% last year, it didn't bottom yet. It didn't bottom until March 23rd. That's when it finally bottomed. I kid you not. I could show you the tape. I got on and I said, you know what? If Congress, which had already been working on a stimulus package, if they're going to do a big stimulus package, and we've got vaccines maybe coming out, we weren't sure when. At that point, I wasn't thinking that the pandemic, a year later, we'd still be in it. I don't know how you would consider the economy. I think the economy is probably mostly through it based on employment figures, retail sales, et cetera. We've got a long way to go. Don't get me wrong. When I say mostly through it, we still have a very long way to go. But TSA numbers are up. So that means, transportation, safety and administration, right? TSA. Well, anyway, people are flying more. Gasoline usage is soaring right now. A lot of states have reopened. So people are back for, I would say mostly, certainly a lot more than they were last April and May of 2020. So fast forward to today, we've got a stock market what I was going to say is on March 23rd, I said, I think we hit the low. The low is in. And I've turned into a buyer. I said that. I really did. And so here we are. We're getting back. So here's the 1 year change in the S&P 500. The article that I was quoted in today, Black Monday, a year after historic. I know today's not a Monday, but a year ago it was a Monday. Historic market rat. Wall Street reflects on what it got right, what it got wrong, and I'm in here. I'm in here somewhere. You know, I'm in there, and come on, the screen goes. Come on, screen, come on. Okay, so I'm in there somewhere. I should have highlighted this before I got on. So the point is, the Federal Reserve jumped in and stimulated the economy. They bought bonds. They bought everything. They came back with QE4 and provided so much liquidity to the market because the market started to freeze up, interbank lending, things like that. You know, things started to freeze up. Getting loans all of a sudden was, that was a big worry if credit would dry up. So stimulus checks went out. So Congress did the right thing with a $2.2 trillion stimulus package, if you recall. And that basically got us through the worst, the worst of the whole thing. And that was really incredible how quickly officials were able to act. Anyway, I'll link this article in the comments. You could see my quotes and a few of the other people that were quoted. The articles by Martha White, journalist at NBC News. She also writes for a few other major media outlets. So, where could I find my name? All right. It's funny when you're looking for it, you don't see it. Oh, here it is. Okay, look, Mitchell Goldberg right there. And I'm down a couple more times lower in the article. Okay, here's what did I say? All right, along with aggressive policy intervention, stick with me, guys. I'm getting through this pretty quick. Okay, along with aggressive policy intervention, technology was the grease that kept the economy's gears in motion. It was the first time. This is like my key thing. It was the first time that our society has gone through such a crisis while having high-speed internet access, Goldberg said. This not only helped facilitate the continued operation of consumer spending and business activity, but it proved to be a boon for Wall Street itself. I think people in financial services are very fortunate. This is my quote. This is what I said. I said it, so it applies to me. We benefited from a rising market. We benefited from the ability to work from home. The stock market kept going. The stock market didn't close. It wasn't like a restaurant. Look, I know I'm fortunate to be in financial services right now because the market recovered almost as quickly as it went down. And Wall Street had a banner year. I would not have thought, I thought the bottom was in last March 23rd, but I wouldn't have thought that we would have had such a good year in 2020. But as the year went along, what happened was, the S&P 500 went to new highs. That index, okay, by the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. The index is weight based. Okay, the biggest companies in the index have an outsized impact. So a stock like Macy's has no impact, almost no impact at all on the S&P 500. But a stock like Apple or Amazon has a big impact in the S&P 500. So you had your biggest six stocks. There were others also, but Facebook, Amazon, Alphabet, Netflix, Google, Microsoft, and others, they did well. And since they're the biggest stocks in the index, they also had an outsized impact in the index. That's why the index was able to go up and up and up while the economy was going down and down and down. And that's what people don't get. The S&P 500, it's an index that measures the performance of the biggest of the stocks of the biggest publicly traded companies, not the economy. Okay, you have to separate those. The stock market and the economy are not directly linked over short periods of time. Obviously, if the United States had no prosperity whatsoever going forward, the stock market eventually would succumb to that. But over the short term, the stock market is the stock market, the economy is the economy, and they are two separate things. Let's take a look at how we did today, okay? The Dow off 127 points. Look, we've just been hitting high after high. So the fact that the Dow closed down less than 0.4% today is really nothing that concerns me. It was down actually more earlier in the day. NASDAQ had an okay day, was up slightly. S&P was off a tiny bit. Gold up a touch. It confuses me with gold and Bitcoin, because if you believe inflation is coming up and there's too many dollars, or the dollar is just not going to be worth anything because of all the printing and borrowing, well, that's been one of the reasons that is given for the rise of Bitcoin. But gold hasn't been moving up well, it certainly hasn't moved up like Bitcoin, but it hasn't really been trending higher. Gold has been pretty flattish for a long time. So if you really believe inflation is coming, if big market players believed in the inflation story, you would think that they'd be buying gold. So gold, it's not really at this moment sending an inflationary signal. And I think gold for so long has been a good inflationary signaling thing. I can't say stock gold it's a metal, but just wanted to point that out. Okay, let's take a look at some of the other commodities. Gas, silver off a little bit, copper off a tad bit. No gigantic moves. But copper down almost 2% is, economically sensitive stocks came off a little bit today. Copper is certainly economically sensitive. It's not a stock, but they call it Dr. Copper because it measures, you could use it to measure the health of the industrial / manufacturing / real economy. 10-year yield up a tad bit at 1.61%. Let's take a look at some of the cryptocurrencies. Let's just take a look at Bitcoin. Bitcoin, barely off. I mean, it was over 60,000 over the weekend. It's 56,000 now. 55,000 last week was like, wow, it's high. So the fact that it's 56,000, it's off a little bit from its high over the weekend, which I think lasted for about 4 hours, doesn't really concern me. The question about Bitcoin is, do you want to take Bitcoin seriously or not? The way I look at whether or not you should take Bitcoin seriously is this. Forget your opinion. It's not about you and me. It's about what our fellow investors are doing. Maybe you don't care about Apple stock, for example, but or the stock market, or you're just not so into the day-to-day vagaries of the stock market. Okay, fine. But it's what your fellow shareholders or your fellow investors do, your fellow market participants. So if Elon Musk puts some of Tesla's treasury cash into Bitcoin, and PayPal does, and other companies, one way or another, if you own an ETF or a mutual fund that mimics the S&P 500, you're starting to, in the slightest way, you're starting to gain exposure to Bitcoin. So do you take it seriously, or do you say it's a fad? I think you have to take it seriously. Bitcoin in and of its own is $1 trillion asset. $1 trillion is, if it's so big and it goes down a lot, is it big enough to take other assets down with it? Is it big enough to cause a shock to the financial system? At this point, I think so. So it definitely warrants your attention, whether if you want to buy it or not. That's a different story. But I do think it should be taken seriously. Okay. Yesterday we spoke about the dollar. And what I said yesterday about currency is if we didn't have a dollar and we decided to invent the dollar today, it would look nothing the way it looks right now. It would look nothing like it does today. It would be digital. It would be a cryptocurrency. In my opinion, my very, very strong opinion, the dollar would look like a cryptocurrency. I like to think that we are still using paper, which is like, paper money, a dollar bill. It's like a contract, it's a dollar, it's legal tender. It's a contract, right? Money's like a contract. You could say money is a contract. It's paper, and we're using metal like coins. So like we're still using round pieces of metal and paper for currency. It's like thousands of years old. I mean, today we're mostly going to digital wallets, and we have, Apple Pay or whatever you have on a Droid, and we're all basically going digital anyway. So we're moving to digital. We basically have digital currency where the Federal Reserve prints over $100 billion a month. They're not actually printing cash. What they're doing is they're giving electronic credits, electronic currency to banks so that banks have a lot of money on the books to ride out tough times and to make sure that they're comfortable lending money. Okay. So that is it. And let's take a look at the watch list. See, these are some of the things that I look at every day. I don't know. I hit that button, but here, let's get back to list. I change a couple of things with my technology, and things are moving on the live stream so much faster now. So I always take a look at the FANG stocks because you all have them, right? But Facebook, it did go over 280 today, but Facebook is not far. You see this red line over here? Let me make this. Wait a minute. Am I sharing the screen? Let me share the screen. Okay, let me share the screen over here. Facebook. You see this red line over here on the Facebook? Facebook is just about 280, not far from its all-time high. Google, Alphabet, continues to move up. Good day today, up almost $30. Apple up slightly, up 1.27%. It's more than slightly. Microsoft up over 1%. Netflix and Amazon up. You could tell why the S&P 500 would have a good day. So today was more of a day for the work-from-home, stay-at-home stocks. A little give back for the economically sensitive stocks. Let's take a look at which sectors did best today. Communications, technology, utilities, staples. Yeah, these are the stocks that would say slower economy or not economically sensitive. I'm not saying technology is not economically sensitive, but technology right now is thought of as an asset that will continue to grow earnings regardless of what the economy does. All right. And at the bottom of the list is energy, but energy is way up this year. XLE is the big ETF that tracks the energy sector. And just to give you an idea of how it's done year to date, it's up almost 36%. So the fact that it backs off a little bit doesn't really get me too worried. Okay, let's get back here. All right, so we're back in the share screen. Let's talk a little bit about the tax stuff. Okay. There is stuff all over the internet that you could look up and find yourself, and it's so much stuff that after a while your head starts to spin. So I found a couple of good articles that summarize everything, but I'll give you my own quick summary, and then we'll take a look at some of the more specifics. I want to wrap this up in about 2 or 3 minutes. Okay, so who's out there, by the way? Let's see. Judy is out there with a heart. Love you. Ron is out there. Thank you, Ron. Folks, you're watching this. If you're watching this during the live anyway, give it a thumbs up, give it a heart. Give it a laugh reaction. Come on, let me know you're out there. If you do give it a reaction, I'll be able to see your name and I can see who's watching it, which I would always enjoy. If you want to go anonymous, no problem. Or if you're kind of just listening to it, you're driving your car listening to this, then skip it. Don't want you to do anything. Don't look at the screen on my account when you're driving, okay? But Ron is out there. We've got a couple of comments to take a look at. Mitch joins the Grateful Dad covers band. I like that, the Grateful Dad. You know what? We could do like a middle-aged guy's Grateful Dead tribute band and call it Grateful Dads. You like that? LinkedIn tip. Look at StreamYard destination settings to reconnect to LinkedIn. It dropped Facebook on Sunday due to a security update. Mother of mercy. You know what, Ron? I didn't get to schedule this until after the show started because I missed the hour deadline before LinkedIn. It was just out a lot today. And I'm not even streaming right now to LinkedIn. So thank you. It would have been a good idea to do that though. But link to Black Monday, NBC News. Bada boom. That's my article, man. Thank you very much. Thank you. And Ron is still out there. You just put me out there. You're like my number one fan. Hey, Josh Brown, he only uses the man size tissues. There is such a thing as like really big tissues, Wearing clothes is also a few thousand years old. Yeah, so maybe we're not. I'm not even going to go there, buddy. Josh, you and I always have a lot of laughs together. Yeah. So look, we could wear digital clothing, right? Is that what you're saying? But it would still be digital. So it wouldn't be like see-through clothing. You just maybe have we'd wear like aluminum foil outfits, right? And say, this is my new digital clothing. It's aluminum foil, right? Be kind of warm though and uncomfortable. Okay, so let's get back to the screen share. Thank you very much for sharing your opinion there, Josh, about clothing being a few thousand years old also. But you're just killing me, man. Okay, let's go back to the screen share. All right, I'm back up here. So let me see if I can make this a little bigger for you. All right. The value of itemized deductions for those who earn more than 400,000 will be capped at 28%. The Internal Revenue Code's 1031 like-kind exchange would be eliminated for individuals earning more than 400,000. A 1031 like-kind exchange allows a swap of one real estate property for another in a way that offers tax advantages for investors. This is huge. I mean, this is like a very big thing in my world where I live on Long Island, where there are, real estate, both commercial real estate and residential real estate are very big parts of our local economy. And I'd imagine it's like that pretty much from wherever you're watching. But basically, you could buy or you could own a commercial building or an apartment building or, a small strip mall, whatever. And if you sell it, you owe capital gains. But if you do it right, you could move the money into another property and avoid paying the capital gains. It's one of the things that keeps investors in real estate. And it's one of the reasons why a lot of people don't completely just sell their real estate and go into cash or some other asset because of the tax breaks that they get from 1031 like-kind exchanges. So that would be a big thing. And it would eliminate it for individuals earning more than $400,000. But, to me, individuals who make under $400,000 for the most part don't really do, not a lot of them anyway, are doing like-kind exchanges. You think you have to be a real estate owner, and which means you're probably well off. Okay. And that's a big thing. For taxpayers who earn more than $1 million a year, dividends and capital gains, think stocks, will be taxed at ordinary income rate of 39.6%. Right now, the capital gains rate is 20%. So think about that. If you earn more than $1 million a year, your capital gains taxes for long term, it doesn't say long term or not. So look, obviously this is for long term because right now short term capital gains are taxed as ordinary income. So what this is saying, if you make over $1 million, long term capital gains would be taxed at the top up to 39.6%. Okay. Well, if you're making over $1 million a year, you are in the highest tax bracket, which would, under Biden's proposal, the top tier tax bracket now is 37%. It was cut from 39.6 by Trump's tax proposals which became law in 2017. It would go back to 39.6%, but your capital gains taxes would go up a lot. Now, I have, clients who have substantial long-term capital gains, and they've planned on that long-term capital gains tax rate, and it's substantial money. So now all of a sudden, their taxes they pay are going to be double. I mean, you think about it. If you're in my shoes, you've got clients who could have millions of dollars in unrealized capital gains, and all of a sudden they're thinking 20% to almost 40% tax rate. That's a huge hit. Again, these are proposals, and like trial balloons, these will be set afloat, and a lot of them are going to be shot down. And this is not something that's going to work with reconciliation, because you're going to have to get all of the Democrat senators on board. And I could tell you, Senator Joe Manchin of West Virginia has already come out and said, we've got to have something that's bipartisan. And I can't see this getting through anything bipartisan. The step-up basis on assets left to heirs would be eliminated. This means that beneficiaries would lose the opportunity for the value of inherited assets to be set on the day of death. Instead, what when the assets are sold, the beneficiaries would pay the same tax and capital gains that the decedent would have owed. So let's say you bought Microsoft at $1. You have 1,000 shares, $1,000. You're a relative of yours left it to you, and now it's worth, let's say 200. I don't know, 200. And where'd Microsoft close to? We just looked. So let's say $235,000. So if that person, if you inherit it from somebody who, let's say, dies today, knock on wood, not putting a curse on anybody, but your cost basis would be $235,000, today's closing price. But what Biden's proposal says is, no, your cost basis is $1. And if you make a lot of money, about 40% of that is going to be capital gains taxes. So the whole, almost half. That's what that does. It gets rid of the step up basis. That's huge also. Okay. The deduction for contributions to 401k plans in retirement would cease under the Biden proposal, and a flat 26% tax credit would take its place. All right. Well, not too bad. It's like the one okay thing, right? The threshold for the estate and gift tax would be reduced to $3.5 million. It's currently about, I was just going to say, it's currently about 11.7 million, which it says it right here. It's like 11.6 something million. It's not exactly 11.7 million. And that would be lowered to 3.5 million. And the top estate tax would rise to 45%. That is pretty huge, but wealthy people also use lawyers. Like I know in my region of the world, tax and estate lawyers, there are a lot of good ones in my neck of the woods. And imagine there's a lot of them, and there will probably be a lot more because those lawyers are going to be extremely busy. But you'll use trust accounts and, asset movement strategies to get out of that. I'm not a lawyer, so I'm not giving you legal advice. So you'll have to go check that out with your own tax professional. Okay. This is what to tell clients. This is an article that was written for people in my business, obviously. But I think I've told you what you need to know. I'm already up on this. I've actually created a post. And if you want this, I sent this out January 15th. This is the last thing I'm going to say, and then we're going to end it. But I sent this out January 15th that if you take a look at the three taxes that the Fed could control, that the federal taxes on the federal level, corporate, personal, capital gains. Most of the time, almost every time when these rates go up, the stock market has actually gone up. It went down once in 1969 during the height of the Vietnam War. Okay. So there's a lot of things that impact the stock market. It's not just capital gains or income taxes. It's interest rates, government spending. If government spending accompanies tax hikes, that has actually been historically pretty good for the stock market. Clinton raised taxes in 93, and that didn't start, but it was, what started at the time was an economic boom and rising stock market. But we also had low inflation, oil was going down, and we had the invention of, or we had mass adoption of the internet. So there's so many things that could impact the stock market besides just taxes, that, there's innovation also. So we can't just say this is bad for the market, this is bad for home values. We don't know. And again, these are all, what I just read to you are, let me just get out of the share screen. These are all proposals. Proposals get shot down, things change. This is a pretty aggressive thing that Biden put forward, and we'll see what he could get out of it. I don't think he gets everything out of it. I don't want to speculate if he'll be close or not, but I'm pretty confident in saying that a lot of these things will be shot down, reduced, and changed if he wants to actually get something done. All right. I really appreciate you watching. Today is Tuesday. I'll be back tomorrow. And if you have any questions, again, don't forget, hit me up in the comments. If there's something in particular, a topic that you want me to cover, I'd love to know about it. Catch me on Instagram at InstaMitchG. Connect with me on LinkedIn, Mitchell Goldberg on LinkedIn. You'll see my picture there. I'm wearing a pink tie. And my business Facebook page is Client First Strategy. And my YouTube channel is also Client First Strategy. And I'd love for you to go over there right after this and subscribe. Okay. I'll talk to you soon. Thank you so much for joining me. Oh, Andrew Hirschon and Stacy Billing. Thank you very much, guys. Really appreciate you joining me. Take care.